Just a note about support material 6. It's obviously study unit 6. Last week we spoke about deductions and allowances. What is a deduction and allowance? Like, how would you define it for us?
I would define deduction and an allowance. It's something that is being taken off your, I believe, your taxable income.
No, not take it off your taxable income.
No, it's actually taken off. It's your income, off your income.
Okay, because we want to get that.
Yes.
Okay, we want to get that, so it comes off the income.
Yes, sir.
So does it help us?
Yes, so it does help us. Helps us pay less. So
businesses want to deduct more or less?
They want to deduct more.
Exactly. So businesses will then have the burden of proof. Remember we spoke about case law and how cases affect tax. Everything's based on the law of precedent, right?
Yes, sir.
So what does that mean?
It's based off of what happened in the previous case. So to create some sort of, I don't want to say routine, but what happened to one taxpayer should happen frequently to all taxpayers and apply.
That's actually a good way of describing it. Yeah, it's almost like fairness in a way, because obviously the law is what we're following in terms of the rules and policies of the country. And SARS is going to apply the legislation, and they will have certain ways of applying the legislation, because remember, case law or law in general is subject to interpretation, because law can be quite subjective, because a judge or someone that's more senior would actually be deciding on whether the case or the merits of the case are fair, and if they are, then they would basically give a judgment. And then if they've given a judgment on a specific topic, that judgment is obviously binding for future cases going forward. Does that make sense?
Yes, sir. Yes, sir.
Okay, so just to recap here, remember, we're trying to get to taxable income, because the taxable income is what I then use in terms of the tax tables if I'm looking at a micro business or an SBC, or I would use 28% flat companies tax if that's the scenario that I'm dealing with. So when looking at the deductions and allowances, I always have to consider the rules. Okay, the section 11A general deduction formula. Okay, so we spoke about general deductions. I think it's on the next page. No, it isn't. Okay, but maybe just to discuss it quickly. Okay, remember you had criteria that had to be met in order for something to be deductible. Right, so what was the fourth or the fifth line? Do you remember the definition?
The definition, a trade that was actually incurred during the year of assessment.
Yeah. What's the most important thing? Capital or not?
Or that it should have not been of a capital nature.
Very important. Okay, so not of a capital nature, because what are we dealing with here? We're dealing with income. Do you agree?
Yes, sir.
Is income capital?
No, sir.
No, it isn't. Income is what I derive from using capital. Right, so if I buy a building and I rent it out, the income would be the rent income, and the capital would be the property. Do you agree?
Yes, sir.
So when looking at deductions and allowances, these things represent things that affect the business in terms of their operations. So if a business is going to be paying water and electricity, do you think they'd be allowed to deduct that?
No, sir.
Water and electricity?
No, I don't think so. Well,
yes,
they use it. They will use it to create. Yes, sir.
Yes, they will. Okay, water and electricity would meet the general deduction formula. It would meet all the criteria. It's not of capital nature, right?
Yes, sir.
Okay, so water, electricity, anything that we are going to be making use of over the course of the business. Remember, it can be actually incurred or paid. It doesn't really matter. But the thing is, so long as you've basically incurred an expense, that expense could meet the definition of a deduction or an allowance. and then the deduction or the allowance would then be removed from your income in order to reduce it to get your taxable income. So taxable income is what we're trying to get. So obviously, as a taxpayer, you would want to try to deduct as many deductions as possible in order to reduce the amount of tax that you're going to have to pay, right, in line with the law. Right, so as long as you're following the rules, as long as you're following the law of the country, you aren't going to get into trouble because you've correctly followed the legislation. Right, and that's why we need to look at two things, not only the cases, but also the acts. Okay, so the Income Tax Act, and then also we need to look at this, the interpretation notes.
Yes, sir.
Because SARS will tell you how you should treat certain things. Right, they will give you guidelines. They'll say, well, based on the legislation, based on what the Act says, this is what we are going to have to do. Right, so now, obviously, we spoke about things that are not capital in nature. So, if I'm going to be spending money on capital, would I receive any deductions based on the general deduction formula?
No, sir.
No, you wouldn't. But let me ask you this. Are you spending money?
Yes, sir, you are spending money.
Yes, you are. But notice what you're spending money on is different. So if you buy a computer, if you buy a vehicle, if you buy property, if you buy machinery, those items are all considered assets. Things that I've bought to hold and things that I'm going to be using to generate business, okay, or to create income. Does that make sense?
Yes, sir.
Okay, so now what are we looking at tonight? Well, we're looking at this. Capital allowances. There's the keyword, capital. And now we've got the word allowance. So it's something that you can claim as part of your assets. Okay, and things like depreciation. That's one example. Depreciation. Okay, something as simple as depreciation can be taxed, tax deductible because that's wear and tear. Okay, the SARS, SARS will view depreciation from their perspective, and they call it a wear and tear deduction. Right, so depending on how much accounting you've done, maybe you remember a little bit of this, the Section 11E, wear and tear deduction for property, plant, and equipment. Is that alright?
Yes, sir, that's fine.
Okay. So now, if I'm looking at this capital deduction or this capital allowance, do you agree that this capital allowance is only going to be applicable to certain types of assets? And different assets will have different deductions.
Yes, sir.
So we need to look at the types of assets. And then we also need to look at things like wear and tear, and then something called a scrapping allowance or a recoupment. Those are two other considerations that relate to a disposal of an asset, i.e. asset realization. Right, so when I sell something, I'm going to realize a profit or a loss on that sale. And a portion of that sale would be considered income, and a portion of it would be considered capital in nature. Okay, so that's kind of what we're focusing on tonight, in terms of this whole idea of deducting part of our capital. Because let me ask you this: if I'm going to be buying a vehicle, have we paid a significant amount of capital or cash for that capital item? Okay, i.e. the machinery or the vehicle.
Yes, sir.
Yes, you have. But now, does the business receive any benefit from that?
No, sir, unless they use it as an asset to generate more income.
Yeah, so that's good. So yes, obviously you would want to use the asset that you've got to generate more income. But if you can't, then what would you have to do?
Well, if you can't, then it would just stay as a capital.
Yeah, it would stay as capital, correct. But then you'd probably want to claim a deduction, because let me ask you this. Will the value of the asset remain the same?
No, sir, it will decrease.
No, it won't. It will decrease, exactly. Right, and that's why, from a tax point of view, even the tax, let's say, authority, SARS, even tax, in terms of SARS, has to be fair for everyone. So they basically provide for businesses to claim some of their capital in terms of investing in different assets as a deduction. Because if they allow those businesses to claim a tax deduction on some of the assets that they would have purchased, would that help them operate as a business? Would that provide them with any benefits?
Yes, sir.
How? What benefit would they get?
Well, obviously, so they would have assets in order to obviously generate more income, sir, and then through that, even though the value of the asset is going down over time as they're using it, but they are incurring some sort of income and growing their business and making more money,
Yes. Okay, so as you said, the key word that I heard there that you should maybe highlight from your answer is the word growth.
Yes,
is it
sir.
important to grow?
Yes, sir, it is.
Yeah, so how does a business grow if they have to keep paying so much tax? They pay tax on their revenue and they pay tax indirectly when purchasing assets because it'll have that. Do you agree?
Yes, sir.
Okay, so what can the company do to offset those negative effects? Well, as you said, the company is going to be buying these big assets. Are those
Yes.
big assets going to help the business?
Yes, sir, they will.
They should. So if those big assets are going to help the business, surely the government would want to incentivize smaller businesses or even larger businesses to keep buying assets.
Yes, sir.
Why? What does
Well,
it do?
I think it's the government's way of helping a business, again, going back to growth, helping the business grow. Because if the government is taxing the business so much, there is very little space for the business to. There's very little space or opportunity rather for the business to grow into
Correct.
this big corporation where they are able to employ more people. So
Yes.
obviously the government doesn't want to tax them so heavily, or perhaps if they tax them heavily, but then they're going to give them capital allowances or any sort of tax breaks where they are still able to recoup some of their money or keep some of their money.
That's good. Okay, I like your perspective in terms of like a tax break. It's a nice analogy to look at that because, as you said, businesses are running and they're trying to make a profit. Right, those businesses that are successful, that do make a profit, well, the first thing they need to consider is paying tax on their profit because that's what they've earned in terms of revenue. Okay, and then
Yes.
obviously if I'm going to be running a business, I'm going to be needing equipment, vehicles, etc., etc. And ideally, the business would want to claim as much of that because, as you said, it's going to offset the tax burden that the company has.
Yes, sir.
Okay, good. Right, so last week we spoke about this whole concept of the tree and the fruit. This week I'm actually going to draw it. Well, you've got a picture of it rather, and let's discuss it. So, do you remember that there was a debate between things that will improve the asset and things that are required to repair it? So, if I asked you about, let's talk about a vehicle. Would the vehicle have any enduring benefits?
What's an enduring benefit again, sir?
Enduring benefit means it's something that you will keep for you forever that's positive.
Wow. A car, I don't think so, because everything kind of not so much deteriorates, but the wheels start to wear down.
True.
The paint will start to fade as time goes by. The windows could possibly break. So I don't see a car having really an enduring benefit.
Okay, so, well, you're actually partly right and partly wrong in a way because you said a car doesn't have any enduring benefit. It actually does. Okay, it's still an item in terms of being like a machine. So, for example,
Yes, sir.
equipment would be considered an asset. Do you agree?
Yes, sir.
Okay, so there will be a form of equipment that will be inserted in a vehicle so that vehicle is more intelligent and that vehicle can provide greater features or capabilities depending on the scenario.
Yes, sir.
Okay, so if I've got the tree and fruit benefit or tree and fruit debate with the enduring benefit is what do I have after I've sold the fruit? So does the tree provide you with enduring benefits?
Yes, sir.
Yes, it
Because
does. Right,
yes.
so the tree, do you agree, would be considered the capital good?
Yes, sir.
Because that's what you've actually bought. What does the tree produce?
It produces fruit.
Fruit, exactly. So that fruit is going to be taxed according to what? Capital gains or income tax?
No, income tax.
Income tax, exactly. So all the fruit that this particular business is going to derive will then be taxable. Okay, and taxable according to those rules.
Yes, sir.
Okay, so when looking at capitalization of expenses to assets, is that possible? Is there such a difference in terms of improvements versus repairs? So you spoke to me about a vehicle that requires new tires. So if you buy new tires for the vehicle, is that considered an expense or is that considered an asset?
I would look at it as a possible asset, actually, in a way. Because I think, for example, if I take this kind of example where if I have a vehicle, right, sir, and this vehicle is perhaps the delivery truck for my business, and this delivery truck delivers goods to wherever, but this delivery truck can't work at its most efficient level.
Correct.
Because of the worn out tires, for example. Whereas when it has new fresh tires with good treads, and so on and so forth, it is able to brake quicker, probably drive a little faster, get to places and deliver the goods that I need more efficiently than when I didn't have those that improvement or those tires that I've added.
All right. So if you're adding the tires, do you agree? Does that add value to the vehicle? Does that just keep the vehicle running?
I don't think it adds value. I think it keeps the vehicle running because either way, the value of the car is still depreciating. The tires are not a significant enough or a big enough part of the asset to then call it, I suppose, an improvement of some sort.
Yes. Okay, that's a really good description. So when looking at this, capitalization of expenses to assets, the big question that you need to ask yourself is, am I improving the capability of the actual asset? So if I'm looking at this tree, okay, let's say I'm going to be buying something that's going to make the tree stronger. Okay, let's say I'm going to put like metal wire around the tree to support it and protect it so that the tree can grow taller, and if it's taller, it'll obviously hopefully provide more fruits.
Yes, sir.
Okay, so in other words, how do we make a bigger tree? How do we make the tree more valuable? See, that's the big difference. All right, between paying for capital expenditure and paying for revenue expenditure. That's some of your accounting.
Yes, sir.
Okay, so capitalization of an expense will only apply if the value of the asset had to increase. Okay, 3 more questions here for you to consider. The financial statements, what system do the accountants use to prepare them?
On an ongoing,
The system. The rules, right?
Yes, sir.
So do they use accruals or do they use receipts?
I would believe accrual, sir.
Yes, and what does an accrual mean?
Accrual means that you will account for what has happened you'll account for what has happened within the period in which it has happened, irrespective of when you receive the financial benefit of the money.
Okay, so if you're looking at the accrual system, right, so if I'm looking at the accountants, they're looking at things that have been bought in terms of incurred expenses, and received or earned income. So either received or earned, or incurred or paid.
Yes, sir.
Okay, so if I'm looking at preparing the statements, they're going to be following their own set of rules, which is generally the IFRS. Okay, because you require those rules. That would be like the main body or the rules that need to be followed to create those statements. And now SARS is going to be using what? Do they use IFRS?
No, sir.
What do they use?
Well, SARS have its own rules for.
Yes, and what do they follow? What does SARS follow and implement? We spoke about the structure of the tax system. So the tax system is based on legislation, right?
Yes, sir.
So what determines how a business operates in terms of taxes and paying its taxes?
Well, the law, sir.
Which is the Act, the Income Tax Act.
Yes, sir.
Okay, so the Income Tax Act is going to provide for certain deductions, but not all. Right, so are the systems the same?
No, sir.
No. Okay, because in the Income Tax Act, we look at something called like wear and tear, and then in the accounting rules, we look at something called depreciation. But our depreciation, is depreciation and wear and tear the same thing?
I think so.
How?
No. Well, I think because either way, wear and tear and depreciation, the value of the asset is going down, sir. So I believe that they're the same or at least they built on the same premise of the asset decreasing in value over time.
Good. Okay, so you're right. The systems are similar because if I'm looking at an asset, you're going to be decreasing the value of the asset. But
Yes,
they're
sir.
still slightly different because the one is based on what will happen in the future, and the one is based more on what's happened presently. So
Yes.
the big debate here is, well, these capital allowances, can I or can't I deduct them? Because a business would always want to try to reduce the taxable income as much as possible, even if that's relating to something as simple as a purchase. Okay, that purchase
Yes,
will
sir.
hopefully be deductible in some way or another. Is that right?
Yes, sir.
Okay, so let's look at this then. A deduction. Okay, if I'm looking at a deduction, how is a deduction different from an allowance?
I think a deduction is obviously something that we're taking off of that we're taking off of our income. But an allowance, I think an allowance it's something that, even though we're also taking it off our income, but I think it is perhaps maybe subject to certain rules, or it's subject to what's happening or what you're using that asset for, or what you're using that certain good that you're trying that you want allowed for.
Yeah, so why would a business buy assets? They want to increase capacity, do you agree?
Yes, sir.
So a deduction would be something that you can claim, do you agree?
Yes, sir.
An allowance is something that you can't claim, but can you deduct a portion of it?
Yes, sir.
Yes, you can. So let me ask you this. If I buy a truck, and you're going to use that truck for transporting your goods around the city, does that make
Yes,
sense?
sir. Yes,
Buying
sir.
the truck, is that expenditure, or buying the truck, is that capital?
Buying the truck is capital, sir.
Good. So would you be taxed on that?
Yes, sir.
Taxed?
No, sorry, sir. It's of a
If you
capital
say
nature.
yes, what do you mean? How will it be taxed? You're not wrong.
Yes. Well, no, I don't see. Well, I think it would be taxed because it's an asset, and we are obviously having added it to our business. I think that would result in it being taxed, sir.
Okay, and then allowance is something that we can allow, so a portion of it. Do you agree?
Yes, sir.
Okay, because obviously SARS wants to incentivize you to buy more assets, right?
Yes, sir.
So the only way to incentivize you to buy more assets is to offer a better product in terms of other facilities, newer facilities, etc., etc.
Yes, sir.
Okay, so are they the same? Is the deduction and allowance the same?
No, sir. I think they not so much perform the same thing, but they both get removed from income, but they aren't the same. Hello?
Yes.
Oh,
So,
yes.
sorry, I lost you there. Just to repeat that, so you said it wasn't the same, meaning that the deduction is something that I get to claim off my income, because this relates to the generating of income. Do you agree?
Yes, sir.
This relates to the capital. But are they the same ultimately? Yes, in a way, because they're both needed to get what? Taxable income.
Yes, sir.
Does that make sense?
Yes, sir.
Okay, so taxable income is just the amount that we are actually going to be using to calculate the income tax. What I actually need to get there is I need all the deductions and I need all the income. And I need all the allowances. Okay, so it's the same because both a deduction and an allowance will reduce what? Your income in order to get taxable income.
Yes, sir.
Okay, so it doesn't really matter what you call it. That's why when you look at the template, on the template we had what? Just one line called deductions and allowances. Do you see that?
Yes, sir.
It was just one line. Because at the end of the day, they're exactly the same. Just the one is on income and the one is on capital. Does that make sense?
Yes, sir.
Okay, so what contributes to business growth and development? We just spoke about it. Assets, right?
Yes, sir.
Okay, do you need them?
Yes, sir, you do.
Yes, you do. Okay, so let me ask you this. Without your camera, would you be able to take photographs?
No, sir, I wouldn't.
No, you wouldn't. Okay, why? Because that's your asset. That's your business's asset. And would you be able to claim that as a deduction?
No, sir. No, sir,
not?
because it's of a capital nature.
Exactly. See, it falls flat when you talk about a deduction because it doesn't meet the general deduction formula.
Yes, sir.
But does it meet the definition of an asset?
Yes, sir.
So can you claim it? Not you can't
Yes,
claim it, but you can claim a portion of it, an allowance.
Yes,
Does that make
sir.
sense?
Yes, sir.
Okay, so maybe just to write down one more note here. What incentives do businesses have to grow? Capital allowances.
Yes, sir.
Okay, so let me ask you this. If you could write off your camera, would that incentivize you to buy another one?
Yes.
Yeah, it should. Because
Yes,
do you
yes.
agree by buying a new camera, you'd be able to deduct that from your income. So you actually
Yes.
pay less taxes.
Yes, sir.
Okay, so it actually makes sense to invest in assets that you would be able to claim an allowance for. Because SARS will allow you to claim a portion of it as a benefit. Okay, and that helps encourage small businesses to grow. Make sense?
Yes, sir.
Okay. So just to recap, general deduction formula, there's it. We've got certain expenses may be claimed as an allowable deduction. Allowable meaning we can claim it. So when is something allowable? When it meets the definition of general deduction.
Yes, sir.
Right, section 11A. Expenditure and losses that are actually deductible, okay, or deductible for income tax purposes are expenditure and losses that must be actually incurred during the year of assessment in the production of income, not of a capital nature, and laid out for the expenses expended for the purpose of a trade. So if it's not capital, can I claim it? Yes. If it is capital, can I claim it?
No.
No. So can I have 4 of the 5 options being ticked?
No, so you have to have all of them.
Yes, you have to tick all of them, exactly. So remember, SARS will only give you a deduction after you've managed to tick all the right boxes.
Yes, sir.
Because remember, SARS's role is to collect tax. Right, and they want to try to collect tax from as many people as possible. And people would then want to classify something as an asset rather than income. Because if you classify it as an asset, would you be able to hold it for longer and without having to incur lots of tax?
Yes, sir.
Yes, you would. Okay, so remember, deductions are only applicable if they are not capital in nature. That's very, 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 very important. Right, so if things are capital in nature, then what do we do? Any idea?
If they are of capital nature, I think we could try look for an allowance for them.
100%. Okay, and that's where the allowance stuff comes in. Right, so your first one. How can government incentivize the purchase and use of these assets? We just spoke about it. What incentivizes a business to buy another tractor, to buy another vehicle, to buy another truck?
Allowances and deductions, sir.
Yes. Don't really talk about the deductions. Rather talk about the allowances. That's right.
It's allowances. Yes.
Yeah. So allowance refers to something of capital nature. I didn't write that in. Let's write it in. And do you agree all these assets will help the business grow? Do you agree?
Yes, sir.
Okay, that's capacity. Right, so the more of this I have, the more productive I can be as a business. But now what's stopping me from buying another building, or what's stopping me from buying another item of equipment? It's probably the fear of not being able to reap the benefit of buying those assets. Does that make sense?
Yes, sir.
So now if you're running a farm and you've got those tractors on your farm, and the one tractor is doing just fine, plowing the land and harvesting and whatever else, but now I have this incentive from government in terms of a deduction against my capital, meaning if I have to buy a new tractor and that tractor is faster and more efficient and it saves more power, is that a good idea for the country?
Yes, it is.
Yes, it is. But does the business have any incentive to buy those assets?
Well, no, not yet, sir. Well, it has allowances.
Yeah, so no in terms of general deduction, but yes in terms of allowances, correct?
Yes, sir.
Does that make sense?
Yes, sir, it's making sense.
Okay, so we get two types of assets. You get movable, which is this one, okay, or these ones. Let me show that. And you get immovable. Immovable are things that are fixed in terms of like land and buildings.
Yes, sir.
Okay, they're immovable, meaning once they're attached to something, they become part of it. It becomes immovable. Movable meaning there's obviously mobility. You can take it around and you can change things, etc., etc. You can move it, you can use it, etc. Right, so the purpose of the asset is very important. When I say purpose, okay, let me ask you this. If I'm buying tractors to resell, can I claim a capital allowance on them?
No, sir, because that would be... Well, if you're reselling them, that means that's your inventory, so it's not of a capital nature. It's more income based.
Well done. That's perfect. That's the right answer. So we definitely need to consider the purpose. Okay, what is the purpose of the asset? If you know what the purpose is, you would know how to treat it. Another thing, just as a tip, and that's why I've got these slides here, is you need to look at the type of business ownership. Okay, reason being, if I'm a sole proprietor versus an SBC or versus a micro business, are there benefits to being a micro or SBC?
Yes, so there are benefits.
There are benefits. Right, so what must the business do? They need to keep track of records. And how do they do that? Through a system of accounting. Right, so accountants would generally identify the transactions that have taken place, and they would then summarize and identify what's happening. And once they know what's happening, they can then apply that to the tax tables. Okay, because then they'll have the income, and so on and so on, and then from income you can get taxable income. Once you've got taxable income, then it's simple to get the amount that's outstanding.
Yes, sir.
Okay.
So does that mean that a sole proprietor doesn't have much, I suppose, not really regulation, but doesn't really have to keep their records or have any point at which they might have to have that burden of proof as well?
Yeah, it's a good question. So you have to be careful. As a sole proprietor, it's obviously best if you can register everything, the complete process, and obviously convert that into a public or a private company. But ultimately, small businesses like a sole proprietor, their main focus would be just creating value in line with the law and trying to create an asset of value. So when looking at a business that's going to be making use of these products, or if they're going to be making use of the services, okay, obviously products and services will relate to income, in production of income. Does that make sense?
Yes, sir.
Okay, that's if they're using products and services. But now if they're buying equipment and machinery and laptops and computers and screens, is that different?
Yes, sir,
because now it's no more like consumer, now it's more business. And then if it's a business, it'll either be SBC, micro, or other.
Yes, sir.
Okay. Alright, so your first bit is movable assets. If something is movable, that's straightforward, right? I can pick it up, move it around, bring it back.
Yes, sir.
Okay, so there's a special allowance that provides for this. It's called Section 12C, and it's called a wear and tear allowance, but it's very specific to this. Movable assets, and it's on new and used. It doesn't make a difference. But important though, the machinery or the tractor or the item that you've bought has to be used for what purposes? It's over here.
Must be used for the purposes of making a profit, sir.
Yeah, no, not making a profit, just manufacturing.
Of manufacturing,
yes.
Making
a product or a good or a whatever the case might be.
Yes, sir.
Okay, so that's very important, because will SARS allow you deductions with nothing?
No, sir.
No, they won't. SARS is just allowing deductions based on what they've already established in terms of their rules.
Yes, sir.
Okay, so here we've got nature of the machinery, new or unused. If it's new or unused, I get to write it off over 4 years. Okay, would you want to write things off sooner or faster? Not sooner or faster, that's the same thing. Sooner or faster, or slower, or longer?
Well, you'd want to write them off sooner, sir, or quicker.
Why?
So that you're able to get an allowance on that and be able to purchase new assets.
Okay, good. So time value of money, right? You did the DSC module. You know how important time value of money is in decision making, right?
Yes, sir.
Okay, so would I want to write off something over 4 or 5 years?
4 years, sir.
4 years. Okay, in order to write it off over 4 years, it has to be brought into use for the first time after March 20, 2002, basically. Okay, not 20, yes. 20, 2002. Does that make sense?
Yes, sir.
Okay. And the write-off period is 40, 20, 20, 20. So how much does 40 plus 20, 20, 20 give you?
So that's 100%.
Exactly. Gives you 100. So do you agree, how many years would I be able to have claimed this allowance for?
For 4 years, sir.
Well, 4 years if I'm dealing with new and unused, or 5 years if I'm dealing with something that's used.
Yes, sir.
Okay, and then the write-off is quite specific.
So
does
that write-off
apportionment apply? No, it doesn't. So let me ask you this. Okay, so Una, let's say you've been operating for the whole year.
Yes, sir.
Okay, and the tax year ends 28 Feb. Do you agree?
Yes, sir.
And now let's assume that you can go and you can apply and you can get an asset for that last day of the year. Would you be able to claim a portion of it?
No, sir.
Why do you say no?
Would you be able to claim for that last
if it's in production
days?
Of income?
For that 1 day, sir?
Yes. So even if it's on the last day of the tax year, there's no apportionment.
Yes, sir. Yes, that's what I mean. Like, as in, you can't for 1 day. Wouldn't it be obviously for a longer period of time?
No. I think you're misunderstanding apportionment. Apportionment is, do we split it? So here's the thing. Okay, so let's say you buy the camera. So this is January to December. Okay, and you buy the camera in December.
Yes, sir.
Would you be able to claim a capital allowance?
Well, I think so, sir, for the month that I'm using it.
No, not for the month that you're using it. You would get the 40% irrespective.
Yes, sir.
You could have used it for 1 day in this year, and you can still claim the full 40%.
Oh, okay.
Okay, so when I say none, as in no apportionment, it means that you don't have to split it. It just applies to the asset, as long as it's in the year of assessment.
Okay, sir.
Does that make sense?
Yes, sir.
Okay, and if I buy the new camera, how much of the camera's value can I claim?
40%.
40% if it's brand new and unused. Does that make sense?
Yes, sir.
Okay, and if it's not, and it is used, well then it's over 5 years, and it's still 20, 20, 20, 20, 20, which is actually really good as well, right? Because now you get to claim the asset over 5 years.
So if it's over 4 years, does that mean that the first year, so it's 40%, and the rest of the years are just 20%?
Correct, yes. So in your first year, you would claim 40% of the value of that whatever asset, i.e. that's used in the production process to generate something.
Yes, sir.
Okay, because remember, Section 12C is looking at new or unused plant or machinery in the process of manufacturing. That's very important. It must be in the process of manufacturing.
Yes, sir.
Right, so you would possibly be able to claim your camera because it is kind of part of the processing, because you needed to take photographs. The photographs would be the fruit, the camera would be the tree. Oh, you got that?
Yes, sir.
Okay.
And then so when they say written off, that's basically like over how long they depreciate it for.
Yes, written off is the split, so 40, 20, 20, 20, meaning over 4 years. First year I'm writing off 40%, second year I'm writing off 20%, third year 20, fourth year 20, and that's the end.
Yes, sir.
Okay, does that make sense?
Yes, sir.
Alright, so that's the first one. Second one is section 11, section 12E. Okay, 12E, the nice thing about this is if you can remember these section numbers, it impresses the marker. So what I like to do is think of clever ways of remembering this. So how I remember section 12E is I say, well, do SBCs have it easy or difficult?
They have it easy, sir.
They have it easier. Okay, they don't have it easy, they have it easier. Easier meaning there's more deductions that they can claim. Do you agree?
Yes, sir.
Okay, and that's why we've got section 12E here. And this is for movable assets. So we haven't changed focus yet. We're still looking at things that we can pick up and move around. Except this is looking at a special allowance that's only applicable to what forms of businesses?
SBCs, sir.
SBCs, good. So can you have a company that can claim these deductions?
No, sir.
Yes, if they're operating.
Okay, yes, sir.
Okay, as a company, do you agree?
Yes, sir.
Okay, and how much can they claim? Depending on their category, do you agree?
Yes, sir.
Okay, so if you are going to be claiming a capital allowance on movable assets, okay, and you've met the criteria to be classified as a SBC with a movable asset, how are we going to be taxed? Well, if it's a manufacturing asset, can I claim all of it in the year of assessment?
Yes, sir.
Yes, I can. Right, let me ask you the question. Do you have to apportion it?
No, sir.
No, you don't. Okay, so even if it's on the last day of the year, of the financial year, of the tax year, of the calendar year, whatever you want to call it, okay, and I have a manufacturing asset that I just bought the day before the business closed, okay, in terms of its year end, okay, closing its year end, would I or wouldn't I be able to claim that?
You would be, sir, because it's within the year of assessment, sir.
Yes, it's in the year of assessment, so would I be able to claim all of it?
Yes, sir.
Yes, 100% if it's manufacturing. If it's non-manufacturing, only 50%, then 30, and then 20 in subsequent years. Okay, so that's obviously first, second, and then third year. Does that make sense?
Yes, sir.
Okay, and are moving costs allowed to be written off? The answer is yes. So you can actually take that as part of your costs when applying it to a different scenario.
Yes, sir. Okay. And then if it's a non-manufacturing movable asset after 3 years, or does it just stay 20 years from year 3 onwards?
Oh, no. Can I write off more than 100% of the asset, Unam? It's a good question.
No, sir, you can't.
No, I can't. So let's say I buy a 20,000 Rand camera.
Yes, sir.
Okay, really top of the range, nice camera, and that camera is obviously considered movable and it's non-manufacturing. Okay, that's how we'll classify it.
Yes, sir.
Okay, the camera doesn't really produce any like finished product. Okay, it's just a device that allows you to capture photographs digitally.
Yes, sir.
Okay, so if it's a non-manufacturing asset, how much can I write off in year 1?
50%, sir.
Yes, year 2?
30 and then 20. Okay,
exactly.
I understand.
Yeah, so yes, I'm going to write off 10 here, then I'm going to write off 3 there. 30% of that will be 6,000.
Yes, sir.
6,000. 6K. And then the last year is 20%, and then 4K. Okay, so yes, how much is 10 plus 6 plus 4?
That's 20,000.
20,000, exactly. Can I claim more than 20,000?
No, sir.
Why not?
Because you've claimed all of it. No. After the 3rd year, you've claimed the entire 20,000.
Yes, so you can't exceed your deductions. That's the point I'm trying to make with that.
Yes, sir.
Okay, so does that make sense?
Yes, sir, it does.
Okay, so if you are going to be deducting something, it doesn't matter what it is, okay, you can only deduct an amount that's limited or restricted by how much the asset is actually worth. You can't write off greater than that.
Yes, sir.
Okay. Next bit. SBC. Do you remember how they're taxed?
They taxed on a progressive
very good.
Progressive system.
Yes. Yeah, well done. So SBCs are taxed according to a progressive tax system, and obviously it's 0 to 75,750 all the way up until over over 550,000. Okay, just over $500,000. Okay, and obviously we're going to be focusing on what? Operations. So what does capital allowances help us do? It reduces what?
Our income.
Exactly. It reduces your income in order to get your taxable income. So when dealing with a business that has movable assets, we're going to apply 2 different ones. Do you agree? Section 12C or Section 12 E for SBC. Does that make sense?
Yes, sir. Yes, sir.
Okay. If you're wondering what the movable assets are in terms of their deductions, okay, so I just want to highlight this. Section 12C, Section 12E cannot be claimed. Okay, then what am I left with? I'm left with Section 11E. Okay, and 11E is the most common one that we see because this deals with what? Depreciation, or what we like to call in tax wear and tear allowances. Does that make sense?
Yes, sir.
Okay, so is SARS going to have a practice note about this thing?
Yes, sir.
They should. Okay, because SARS is going to allow you a certain amount of years to write off a specific asset. Does that make sense?
Yes, sir.
Okay, so how long am I going to write off an asset as an SBC if it's movable and non-manufacturing?
Depending on what asset it is and how many years. Well, but not more than 3 years. So.
Well, yeah, it does depend, but if I'm just looking at SBC will be 50, 30, 20. Do you agree?
Yes, sir.
Okay. Let's assume that that wasn't allowable. Would we be able to claim any other allowance on it?
If it was not allowable, sir.
Yeah, so meaning you didn't claim any other allowances on the asset.
Well, I don't think so. Well, yeah, probably you could. So, but then it would then obviously have to be an asset. So, other than, yeah.
Okay, so you got the right idea. So if we can't claim Section 12C, if we can't claim Section 12E, can I claim wear and tear?
Yes, sir.
Yes, you can. Okay, and I've tried to give you some examples here. Adding machines, air conditioners, these are some of the proposed write-offs. Meaning, if you buy this for your business, you'd be able to write off that expense over a certain period of time.
Yes, sir.
Okay, that's...
Yes, sir.
Okay. Alright, so that's movable. Now we need to deal with this. Immovable. If something is immovable, it's fixed.
Yes, sir.
Okay, so what determines an immovable asset? Well, things that are fixed to the actual structure of the building or the structure of the asset, whatever it might be. So when looking at immovable, we're looking at very, very large items, okay? And those items will also have certain tax considerations that we need to provide for. Right, so the first one, Section 13.1. Okay, 13 is looking at all immovable. That's what we're looking at. Okay, so building only deduction, 5% annual allowance if used mainly for manufacturing. That's post 1989. Okay, so let me ask you this. Is a company incentivized for building more infrastructure in the economy?
Yes, sir.
Yes, because we've just read that there is a tax benefit or break that they can make use of just for including those individuals, that's not the right way of putting it, including the components, I guess, well, not really components, but the value that's split amongst the different businesses. So if I'm building, let's say I built a building, okay,
yes,
and I'm using the building for manufacturing, what allowance can I claim yearly?
And you use it for manufacturing, you can claim. You can claim an allowance because I think capital. Yes.
Yeah, capital allowance. It's immovable, so it's a 5% allowance. Does that make sense?
Yes, sir.
Okay, but that's for a building that you've built. So if an individual had to build a building and they're running the company as a business, that business would be able to claim a 5% annual allowance just on the value of the vehicle.
Of the building, yes, sir.
Okay, of the building. I mean, it's not, sorry, not vehicle, of the building, yes.
Yes.
Okay, because it's immovable. Right, Section 13 Quin. 13 Quin, see, it's still Section 13, but just a different subsection. Quin.
Yes.
Commercial buildings. Right, so I'm sure you've probably gone to Sandton recently. You've probably seen a lot of those buildings going up, right?
Yes, sir.
Are those buildings for manufacturing purposes?
No, so they don't. I don't think that they'd have manufacturing in them. I think there would be more
office space, right?
Yeah, office space. Yes,
exactly.
That's
right. So would Section 13.1 apply to those buildings in Sandton?
13.1, no, so because they're not manufacturing.
Exactly. Would Section 13 Quin apply to those buildings?
Yes, sir.
Probably yes. Okay, because why? They're seen as commercial buildings.
Yes,
right,
sir.
so commercial buildings, what can I claim? 5% per annum, not a portion. Not a portion meaning again, I can claim the full 5% in the year, irrespective of when I started building the asset. Does that make sense?
Yes, sir.
Okay, well, not building the asset, but building in a way, or creating or buying the asset even. Okay.
Yes. Would a mall be able to? Would a mall fit under this commercial bill?
Okay, that's a good question. Would a mall fit in a commercial building? Yes, I would definitely say so, because a mall wouldn't be manufacturing any items, and a mall wouldn't be considered residential either.
Yes, sir.
Yeah, so a mall would meet the definition of commercial. Okay, obviously commercial is quite broad. So I mean, commercial could be industrial, so like mining or like construction. But then commercial could also be like office, white collar workers, and so on.
Yes, sir.
Yeah, so it's quite a broad blanket. To better answer the question, what would you have to do? You'd have to consult SARS, and you'd have to check their practice notes. And their practice notes will give you more information on what falls under this whole definition of commercial. Okay, because remember, the Income Tax Act is a lot longer than what we've just got here. We've just got like summaries, bits and pieces that come out of the legislation. Does that make sense?
Yes.
Okay, so if I'm just looking at bits and pieces, I'm just pulling out the most important points. So one of the points that was pulled out was this whole idea of commercial buildings versus manufacturing versus residential. But if you've got a building, obviously you want to be able to claim some sort of benefit from having built the building. Because does the government want more buildings to be built?
Yes, sir.
Of course they do, because that creates more value for everyone. Does that make sense?
Yes, sir.
Okay. So in terms of must be for the purposes of trade in production of income post April 2007. That's the key. It must be after that year if you're going to want to claim 5% as a deduction, not a portion. Does that make sense?
Yes, sir.
Okay. Right. So no building. Okay, let me use an example quickly. Let's say one of those buildings in Sandton cost 100 million. Okay? How much could you claim as a deduction?
100 million, 5% of that, which would be
5 million.
Yes.
Right, and what is that going to do to the company's income tax?
It's going to decrease it, sir.
Definitely. It's going to decrease it big time. Do you agree?
Yes, sir.
Okay, I mean, that 100 million rand building is probably going to generate income. Who knows how much income they generate? And if you can claim a 5% not apportioned deduction on that particular asset, would you?
Yes, I would.
Of course you would. Right, because what does that do to your bottom line? It improves it because you end up paying less taxes.
Yes, sir.
Okay. Right, then you've got section 13(6), okay, which is residential units. Right, so again, think of ways to try remember this. So obviously section 13(1) is looking at manufacturing. Okay, so that's like building. Then you've got Quinn. Okay, Quinn is for commercial. So Quinn, how I try to remember these things is like Quinn to me sounds like you know those like in the olden days they used to write with those like pens, and those pens had like a point and it had like a quill.
Yes, sir.
I don't know if you remember what I'm talking about. And like it's like a,
yes, sir.
It's like a feather, and then they write with these old pens.
Yes, sir.
Okay, so when I hear that word like section 13 Quinn, I think about like a quill, and then I'm thinking about like doing business. That I don't know, for some reason that comes to mind.
Yes, sir.
Okay, and then obviously in terms of residential units, obviously what happens in a residential unit, people have that, right?
Yes, sir.
Okay, so you just think of like these funny ways of like remembering these like things because it actually helps when you answer the question. And if you are writing about movable and immovable assets and you've been asked a question about capital allowances, you need to try bring in some of the legislation because it might even give you like marks. It might even give you bonus marks. I've never seen a UNISA tax mark allocation sheet, but I am familiar with how other institutions do it. So like I did tax at WITS and I did tax at UJ, and both used to award marks especially for students that would remember things like this. Section 13, 1, Quinn, 6, whatever. Doesn't matter. But the thing is, if you can remember that, they actually used to award you for it because it showed greater like initiative and understanding. So I don't know if UNISA does the same thing. They might or they might not. But as I said, even if they don't, it's still going to impress the examiner.
Yes, sir.
Okay. And now, what happens here? Well, if it's residential units, so if I'm building townhouses or apartments, can I claim a deduction? Yes. How much is it? 5%. So you can see how easy this is. It's 5%, 5%, 5%. It's all pretty much the same deduction. The only difference is, well, what was it for? Was it manufacturing, commercial, residential?
Yes, sir.
Okay. Just one other thing that I didn't mention earlier. If there's no building meaning you purchased it. So obviously the buildings in Sandton are being built. Do you agree?
Yes, sir.
Okay, so if they're being built, they can use this. If they're not being built, let's say a business bought the building, they purchased the building. If that's the case, then there has to be a 55% adjustment if only a part is purchased, or a 30% adjustment if an improvement is if you've improved the actual building. So that's something to consider as well in terms of the deduction. Okay, so it must be purchased, and 55% meaning it's 55% of the amount of the actual portion that will be deductible. Okay, you'll see it later in one of the examples. Okay.
Yes, sir.
All right. Then the last two is SEPT and QUAT. Okay, so SEPT is looking at low cost residential units. Okay, so still residential, but now we're going cheaper. Okay, low cost residential units. So that could be maybe like entry level apartments, like 1 bedroom, 1 bathroom, that type of thing. Not the more bigger, more developed units. Okay, if that's the case and you're developing those things, okay, 10% of the amount owing, okay, in terms of the loan account, is going to be used as a deduction. Okay, you'll see again, it's difficult to explain it now because we don't have any facts and figures that I can point to, but the key here is just, well, it's 10% of the outstanding loan amount. Okay, because what is the loan amount representing?
How much the taxpayer owes to, I suppose, the bank or whoever else.
So in a way, in terms of financing, obviously you needed finance to raise capital to buy those units or to create those units.
Yes, sir.
Okay, so if it's a low-cost residential unit, a portion of that loan amount is actually going to be allowed as a form of a deduction, because remember, what is the country trying to incentivize? They're trying to incentivize development.
Yes, sir.
Okay, so they're trying to incentivize development. They obviously want you to build, or they want you to create more housing and so on.
Yes, sir.
Right, so they're going to try and make it as simple and easy as possible for you to benefit by claiming deductions to help you with your business.
Yes, sir.
All right, and then QUAT is looking at urban development zones. These two I haven't seen that often in terms of past papers. I've seen the others quite often, so I don't know how popular these two are. They might or they might not. It all depends on the examiner and what they want to test. But just from what I've seen from previous years, they don't really test SEPT and QUAT that often. They test the commercial buildings a lot. That's quite common, and manufacturing as well. Residential, not too much. So mainly manufacturing and commercial is what they kind of test students on. All right, but just to speak to the slide here, urban development zones, refurbishment 20% per annum. Okay, refurbishment means I've improved the actual land or building. Okay, I've developed it. So does the government want private businesses to develop dilapidated buildings, or buildings that are what's the right word? Decayed? Not decayed. Yeah, maybe decay is kind of the right word. So buildings that have decayed over time.
Yes, so they do.
They do, exactly. So what government will try to do is they will try to get private businesses to come in and to develop those zones in order to refurbish them, and they can even extend it. Okay, if it's new or extensions, then it's 20% the first year and then 8% for the next 10 years. Okay, so it all depends. If it's refurbishment, 20% per annum, and if it's new or extensions, 20% the first year, and then 8% for the next 10 years. Right, best example I can give you for this is Newtown.
Yes, sir.
Okay, very, very, very good example of a suburb, okay, a city that, well, a part of the city, more a suburb. Okay, it's just a small part of the larger city, Johannesburg. But Newtown is an example of that. Okay, lots of urban development in terms of refurbishment. Okay, obviously there are some new buildings that were constructed, but some of the ones that were there previously were converted and improved and built on to make it better. Okay, just generally buildings in and around the city that have been almost forgotten and that have deteriorated. If you can revitalize those buildings, you can actually receive a tax benefit for doing it, which is quite interesting. It's an incentive to do those types of things.
Yes, sir.
Okay. Alright, sure, we're almost there. This is quite a technical one. I want to look at some examples tonight just now as well, just to show you the application. This we won't see too much tonight. We'll see it more next week when we talk about CGT. Okay, recoupment and scrapping allowances. Right, the only reason why I've given this to you now is because this is looking at capital allowances as well. Okay, so what did we say capital allowances?
Capital allowances, it's basically an allowance on the asset. Yeah, it's an allowance on an asset, basically.
It's allowance on an asset, correct? An asset that is not allowed to be claimed for, in terms of the general deduction, right?
Yes, sir.
Okay, so capital allowances, because we've got this whole idea of capital, can I buy and sell an asset?
Yes, sir, you can.
Yes, you can. And if I buy and sell an asset, will there be a consequence to that action?
Yes, sir.
Yes, there can be. Right, so the consequence could either be a profit or a loss. So what SARS does is they treat it according to this, recoupment or scrapping allowance. Okay, so I've tried to compare these two here so you have a good idea of what it actually refers to. Okay, so a recoupment is a recovery of a previously claimed allowance. Okay, that's a recoupment. Right, and when will a recoupment exist is when I have a profit. Okay, so let me explain it using an example. Okay, let me say you've got a camera. Okay, that camera has been depreciated, and you've depreciated over 4 years. Okay, do you think the camera's going to have any worth? It probably will, but very little. Do you agree?
Yes, sir.
Okay, and then now what are you going to do? You're going to sell it. Okay, you're going to you want to buy or upgrade, and you want to get rid of the old camera. So you decide to sell it, and if you decide to sell it, you're either going to make a profit or a loss on that sale.
Yes, sir.
Okay, let's assume that you have made a profit on the sale of that asset. From an accounting point of view, the cost minus the accumulated depreciation will give you the carrying value. Are you happy with that?
Yes, sir.
Okay, if your proceeds are greater than your carrying value, I'm going to land up with a profit.
Yes,
from an
sir.
accounting point of view, is that good or bad?
That's good.
That's good. But from a tax point of view, is that good or bad?
Well, no, because then you're going to be taxed more, sir.
Yeah, it would be bad because a recoupment is going to be provided for. Right, and the recoupment is going to be entered into in terms of the taxable income calculation as an additional amount that needs to be included. Okay, and then that is going to actually add to your taxable income in terms of what you're going to have to pay versus improving it or taking it away. Does that make sense?
Yes, sir. Yes, sir.
Okay, so just remember some accounting here and just remember the new terms. Okay, so I have a profit, okay, in terms of accounting when my proceeds exceed my carrying value. Okay, from a tax point of view, I will have a profit which is called a recoupment. Okay, that's the correct term. A recoupment when my proceeds are greater than the tax value. Okay, because earlier we spoke about the business and the tax officers. Okay, so if the tax office is going to be running a schedule of depreciation against your assets. Okay, are they going to be able to work out how much depreciation you're going to be spending, not spending, claiming?
No, sir.
Yes, they would.
Yes, sir.
Okay, because they'll have an idea because they'd know how much you've used. Okay, if it's the asset that's going to be sold. So now the tax value. If I've bought a camera, am I going to be claiming wear and tear allowances for a certain number of years?
Yes, sir.
Yes, you would. So if I'm claiming a wear and tear allowance over, let's say, 3 years, would that be the carrying value or would that be the tax value?
I think that'd be the carrying value, sir.
Okay, be careful. It'll be the tax value if it's the wear and tear allowance.
Wear and tear allowance.
Okay, it would be the carrying value if you use the depreciation method.
Oh, okay.
So the point I'm trying to make is that with a with a tax calculation, we talk about wear and tear, and it relates to the assets that we're looking at. But it's not the accounting; it's actually separate from accounting. It's a separate set of rules altogether. Okay, because we don't. If we wanted to follow financial statements, we would follow cost price, markup, selling, and we work out profit and so on and so on. Do you agree?
Okay, so can I basically sum up? Wear and tear is basically, I would almost say, depreciation to SARS, basically.
Exactly. And that's 100% correct.
Okay.
Okay, that's perfect. And then, well, it's a bit beyond the scope. I don't know. Have you done deferred tax in accounting?
Deferred? Nah, not really. So no.
Really? Okay, but if you do more accounting modules, you'll probably come across a topic called deferred tax. And deferred tax is basically when there are discrepancies between what you've got and what an external party has, like SARS. Okay, because if I'm looking at the income, which is the accounting, and the profit, that's the accounting method. Do you agree?
Yes, sir.
That's one way of doing it. And then you've got the SARS method of doing it. And there could be a discrepancy between the two, and that's called deferred tax. That's just something else that you might or might not have seen yet. Okay, but it's not in this module, so don't worry about it. You don't have to write it down or anything like that. I'm just mentioning it because obviously I know you've done quite a few accounting modules, so I thought maybe you would have come across that concept, but not yet.
Yes, sir.
Okay.
No, sir.
Alright, and then just one last note there. The recoupment is always limited to the previous allowances that have been claimed. So, is SARS fair? Yes, they are. They're not going to be unreasonable. They're going to limit your recoupment to the previous allowances that you were able to claim. That's what they're going to do.
Yes, sir.
Alright, so there's the note about accounting versus SARS. This is just talking about the disposal proceeds from building X used to buy building Y, and then a deferral of the recoupment. See, there's the word deferral here because defer means you're going to leave it for later. Okay, it's like deferred tax. You're not going to pay the tax now, you're going to pay the tax later. But it needs to be provided for in today's terms.
Yes, sir.
Okay, so a deferral of a recoupment means you're going to be offsetting this against something else. Right, and normally offset against the new building. Right, so if we have a new building, it must be purchased or built within 12 months from the disposal date. Okay, that's part of the criteria when looking at this whole idea of a recoupment and being allowed to set off the recoupment against the new building.
Yes, sir.
Okay, because what is the recoupment going to do to my taxable income? Increase it or decrease it?
Decrease it, sir.
Increase it. It's seen as a
profit.
It's seen as a profit.
Yes, sir.
So a recoupment actually increases taxable income.
Recoupment. I thought you said allowance, sir. Sorry, recoupment.
A scrapping allowance decreases taxable income. Okay, does that make sense?
Yes. Yes, sir.
Okay, just keep it simple. If I had to highlight something here, I would highlight these two words. Profit, recoupment, loss, scrapping allowance. Okay, so from a tax point of view, a recoupment will increase the tax that you pay. A scrapping allowance will decrease the tax that you pay. And it arises when I have a capital asset. or asset which has capital allowance.
Yes, sir.
Okay, is that alright?
Yes, sir. So recoupment, so is it almost the same as sort of kind of saying, yeah, you're right, it's recovering something, it's regaining something back. So yes, you're actually very right. Sorry, never mind, sir.
Are you sure? You okay?
Yes, I understand.
Okay. Yeah, so just keep it simple. That's why I've tried to contrast this on this slide. So on this slide, I've tried to show you that proceeds greater than carrying value is profit, proceeds greater than tax value is recoupment.
Yes, sir.
Okay, because remember, the recoupment will be limited to the previous allowances, so this. Okay, because remember, these allowances would have been claimed over the life of the asset. Do you agree?
Yes, sir.
And in this recoupment, because SARS is fair, this recoupment will be limited to that, to the capital allowances. Okay, because then this will still be income in nature.
Yes, sir.
Okay, because let me ask you this. Let's say we've got the tax value here. Let's say the tax value is 100. Okay, let's say the selling price is 500. Okay, and let's say the cost price was 200. The cost.
Yes, sir.
Okay, so now obviously, if you're looking at the cost, do you agree the cost is how much?
200.
200. What is the current tax value? 100. So that means there were capital allowances of how much?
100.
100. So now 100 is going to be treated as what? Income. Does that make sense?
Yes, sir.
Okay,
yes, sir.
and it will be seen as a recoupment, and the recoupment will be part of your normal income tax calculation. And it will be taxed according to income. Does that make sense?
Yes, sir.
What happens to this? Selling price and cost. If it cost me 200 but I'm selling it for 500, have I made a gain?
Yes, sir, 300.
Yeah, and that's CGT. See, that's a different topic altogether.
Yes, sir.
Okay, so CGT is next week's work. This week's work is just looking at this whole idea of an allowance, a deduction that you claim over the life of the assets.
Okay, sir.
Okay. Alright, and then just to summarize, I've put a note here. Okay, so if you are going to approach capital allowances, what you do have to do always is you need to try to follow these steps. Alright, I've tried to summarize all the different considerations here. 12E is the SBC. 12C is the manufacturing assets. Section 11E is the wear and tear. Then Section 13 is the building allowances. Right, those are the deductions and allowances that you would be able to make use of, okay, in a question relating to a company that has immovable or movable assets. So the first thing we need to look at is immovable or movable. Okay, so let's use an example. Let's use a car.
Yes, sir.
Okay, that car is going to be transporting goods, delivery. Okay, so you bought a delivery vehicle. Movable, immovable?
Well, it's movable, sir.
Correct. Manufacturing or not?
It's not.
Not manufacturing. Okay, I will tell you SBC, yes, it is an SBC.
Yes, sir.
Okay, so we said not manufacturing, we said movable, and we said SBC. Okay, so once you've got all of that, do you agree you're going to go to section 12E and you're going to be looking at this? There's it, 12E. And all you do is that. So if the vehicle costs 100,000, how much am I going to write off in the first year? 50. Second year,
sir.
30. Third year, 20. Do you see
Yes,
that?
sir. Yes, sir.
And that's how you do it. It's so simple. You just need to identify what type of asset is it and then approach it the correct way. Okay, so you'll even see later on when we do past papers and things like that, I actually refer back to the notes because everything's in here and then we just need to identify what are we dealing with. What section are we dealing with? Right, and that's why I've tried to give you a summary here because you should be thinking about these questions. Movable, immovable, manufacturing or not, SBC or not. Okay, if you can answer these questions correctly, then you just find what you need. You find this, you find that, you find this, or you find that.
Yes, sir.
Okay, just something else to consider. Some of them are apportioned, and some of them aren't. If they're apportioned, then yes, you do have to take that 1/12 month story. If it's not a portion, then you take the full amount off.
Yes, sir.
Okay. Happy?
Yes, sir.
Okay, perfect. Alright, let's just look at some examples quickly. I'm going to leave the slides up just in case I need them. But let's just go to the study guide quick, and let's look at some examples here. Okay, study unit 6, they've given you... Okay, I do like the way that they've given you a summary of this, because have a look at this picture. What do you see here?
You see exempt income.
You see a breakdown of the different sections of the taxable income calculation. Does that make sense?
Yes, sir.
Okay, why do we need to calculate taxable income?
Well, we need to calculate it so that we're able to then use the tax tables and then understand how much we owe to SARS.
Exactly, because you want the liability. That's good.
Yes, sir.
Perfect. Right, so the reason why we do that is to get the liability, 100%. Okay, just to scan through this, a lot of this we've looked at already. Okay, just repairs and improvements. Remember, if I repair an asset, does that increase the value?
No, sir.
No, it doesn't. A repair would then be classified as a general deduction, Section 11E. Okay, as
Yes.
part of your operating expenses.
Yes,
11A actually. A, not E. E is for wear and tear. A is for the general deduction.
Yes, sir.
Okay, improvements. If I buy new rims for the car, does that increase its value?
Yes, sir.
Yes, it would.
Because
Because the rims would add
rims-
value, but the tires wouldn't. Do you agree?
Yes, sir.
Yeah. So the tires wouldn't be considered capital in nature. The tires would be considered an expense.
Yes, sir.
See, that was the big debate we spoke about earlier. How do we differentiate between something that's revenue and something that's capital?
Yes, sir.
Okay, this we spoke about. They've drawn a table here, movable and immovable, and then they've listed the different sections. This is quite useful as well, just to show the two different types of assets you can get. Then they tell you to refer to the textbook. Then they've given you the 4 and the 5 years, which we saw earlier. Then we had the section 12E. Remember, E is for easy. So SPCs have it easy. SPCs get to claim more. 50, 30, 20.
Yes, sir.
Okay. Then there's the wear and tear allowance. Section 11E. That's fine. We've covered that. We spoke about the not tax tables, the tax years. Okay, here they've given you capital allowances of movable assets. Okay, this was looking at what we spoke about earlier in terms of manufacturing and non-manufacturing. Right, and we also spoke about new and unused. Do you remember that?
Yes, sir.
Okay, so this is just a different way of showing it. You can use this diagram if you want to. You can use the one in your notes. It's still the same. Building allowances we spoke about. Then they give you some examples here. Section 13 Quinn we looked at. That was commercial. 6 was residential. 7 was residential. The one was low income. The one was normal. The urban redevelopment that we also spoke about. Oh, here's an example. Okay, so before I reveal the solution, let's just read this. Okay, have a look at that. Read it quickly and tell me what stands out.
On the 30th of June 2017, completed the erection of a new building. So, firstly, clearly they built a building.
Yes.
That's what stands at first. In the urban development zone.
Good.
That's right. At a total cost of 5 million and brought it into use immediately. Yeah, so they built a new building and it was in an urban development zone.
100%. Well done. So as long as you can pull out those key things, then you just apply it. So 20% and then 8%. Why? This was what we saw here. Let me go back to my notes.
Yes, 20% on the first year and then 8% for the rest of the year.
Yes, for
10, 8% for 10 years.
Yeah, there we go. There's it there.
Yes, sir.
See, very simple. Just keep it simple. And remember, it was the new, and that's why it's this one, and not that one. It wasn't
Yes,
refurbishment. Do you agree?
Yes, I agree.
It was new. Okay, perfect. There's one example. Right, I'm just trying to use these examples just to show you how easy it is. You just need to apply the right legislation, that's all. Okay, then
Yes,
here
sir.
they've given you immovable assets. Okay, you've got the same thing in your note. They've just graphically represented it slightly different here. But what's in the notes is fine. What's here is also fine. You can decide which you want to use. This discussion was look at the scrapping allowance, which is what we spoke about. A scrapping allowance is a loss on the sale of an asset from a tax point of view. So would that increase or decrease my taxable income?
Decrease, sir.
Yes, it would decrease my taxable income. Correct. Good.
Yes.
Let's find another example. Leased assets, points to remember, wrapper. Okay, that was it. Okay, and then they go self-assessment questions. Maybe let's see if there's one that's specific to the. This is tax payable. Okay, that's a long question. Let's see if we can find a shorter one where they talk about the actual separate buildings. This one might actually be quite good. 6.3. Calculate the. Oh no, it's also a long question. 20. Ah, there we go. This is what I'm looking for. These are separate questions. Looks like it.
6.4.
Oh no, still long. Okay, all of these are long. Okay, I think they've changed the questions slightly. Looking at the newer Tax 2601. Obviously, this is the 2018 version. I think some of these might have changed. Before, I recall some short questions, but I don't see any here, which is strange. Okay, maybe they've updated the textbook, which is good because at least it keeps it relevant. But let me just quickly walk you through one or two of these. So let's look at this one. Fixed assets obtained during the year. Okay, let's read number 3. What does number 3 say?
2 small item assets with the collective cost of 4,500 were purchased on the 30th of November 2017. These items qualify for Section 11E wear and tear allowance.
They shouldn't have told you this, but they did.
Yes, sir.
Okay, this in an exam would have been crossed out. Okay, well, they would have just given you the first part. Okay, and then in the exam, they normally would give you yeah, there's it. They normally give you this. Okay, what is that? The write-off periods for Section 11E. Do you see that?
Yes, sir.
Okay, so you don't have to study all the different time frames. Okay, so if you do look at some of them in the textbook, don't worry about them. Okay, you have to be given something because remember that comes from where? The practice notes.
Yes, sir.
Okay, and it's impossible to remember every single item. So UNISA should give you this: vehicles 5 years, undercover parking 5 years, furniture 6 years. All right, and then you would have to apply the right wear and tear allowance in terms of the number of years. Okay, this they said fixed assets obtained during the year, two small item assets with a collective cost of 4.5 were purchased on the 31st of November. Okay, they should have been a little bit more specific in terms of this being furniture or equipment or whatever it is. That was 3. That was fixed assets. That could be fixed assets obtained. So if it's fixed, it would be considered a long-term asset which must be depreciated. So that's why Section 11E comes into it. Okay, not the best question because they didn't specify what the items were. This one's better though. Have a look at this one. Read that one.
On the 31st of March 2018, furniture costing 30,000 and originally purchased on the 1st of October 2016 was sold for 10,000 rand. The furniture was sold to a pawn shop because it was damaged and was no longer usable. No transactions regarding this asset has been included in the taxable income calculation of 5.8 million above.
Okay, so 5.8 million above refers to where do you see the 5.8? Oh, here's it. There's it there.
Yes.
Okay, so here they said taxable income, a close correlation of that before taking the 5.8 in consideration. Okay, so that's fine. So now if you've got furniture costing 30,000, originally purchased on the 1st of October. Okay,
yes,
sold
sir.
for 10,000. Is this a sale? Yes. Okay,
Yes,
if it's a
sir.
sale, are we going to have to calculate the recoupment or the scrapping allowance?
I'd say I'd actually say maybe scrapping, sir.
Yeah, you
I
would,
was gonna,
depending on the value of the asset.
yes, I was gonna say recouping, but then you're not regaining back or recovering any amount,
Yeah, but what must you first work out?
related.
Tax value or carrying value?
Yes, sir.
Right? Okay, so where did I buy the assets?
When did you buy it? You purchased it on the 1st of October, 2016.
Exactly. 30,000. How many months do I write off the asset, which is what? Furniture.
Yes, sir. 6 years.
6
Okay.
years. So divide by 6 gives you 5,000 a year. Do you agree?
Yes, sir.
Okay, per annum. Originally purchased on 1st of October. What's my year end?
31st of March,
31st March 2018.
Yes, sir.
Okay, so from there to there, how much depreciation do we have?
We've got 16, 20,
Let's see, October, November, December, January, February, March. That's 6 months. So 6
Yes,
months
sir.
takes it to 17. So a year and a half.
Yes, sir. So would
So you'll have
we,
5,000, you'll have 7,500. Accumulates depreciation. Does that make sense?
yes, sir.
Okay, 5,000 times 1.5 years. Does that make sense?
Yes, sir.
Okay. So now, if I'm going to subtract 7.5 from 50,000, what do I get? Less 7.5 gives me 22,500. Do you agree?
Yes, sir.
Okay, 22,500 is the carrying value. Okay, or the tax value based on the recoupment, right? How much did I
Yes,
sell
sir.
this asset for?
Sold for 10,000.
10,000. So scrapping allowance or recoupment?
Scrapping, sir.
Scrapping allowance. Good. 12,500 is in a scrapping allowance. That scrapping allowance will be shown as a deduction, okay, in your taxable income calculation. Does it make sense?
Yes, sir. Yes, sir.
Okay,
Makes
let me
sense.
see if I can show you that. What number question was that?
There was question 6.2, question, 6.3, excuse me, sir. Question number 8.
Okay, let's look for it. 6.3 you said.
Yes, sir.
Okay,
Question
there's
8.
6.3. 6.3. Where is our asset that was sold? There we go. See that?
Yes, sir.
12.5. Okay, that's all you have to do. You just have to work out scrapping allowance on the asset that you actually sold as an example. So see, that's the accounting and the tax all in one. Okay, well in this example we had a scrapping allowance. Let me show you one where there's a recoupment. Let me see if there's another example here. Let's see if there's a recoupment here. I don't see one here. Let's go up. Is there one here? 6.1. I don't see 6. Okay, 6.1 has a scrapping allowance, but it's null, so meaning there wasn't one. I don't see a recoupment. 6.2. I don't see a recoupment. Oh, I do see a recoupment. There's it. Okay, let's do 6.2. There's a recoupment. See that?
Yes, sir.
Okay, because I found that students struggle quite a bit with this because it's kind of bringing in some accounting. And again, depending on how good or not you are with accounting, you might or might not struggle with this. So that's pretty much why I'm trying to show you this, just to give you contrast. Okay, let's go back. What page is that on? 30 somewhere, hopefully. Oh no. Okay, let's just scroll. Okay, 6.2.
6.2 on page 45.
45, thanks.
Yes, sir.
Okay, so there's 6.2. Great. I want the adjustment with the recoupment. So let's read the line items here. There should be one that talks about a sale. Do you see it?
13 says lazy.
Ah, there we go. Nice. You got it. Okay,
yes,
so let's read this one together. Lazy sold technologically outdated manufacturing machine Z for 20,000. It was originally bought second-hand on 30 April 2014 for 100 and brought into use on the same day. Okay, so we need to draw a timeline. Timelines are very important when you do anything depreciation related, scrapping allowance related, or whatever. Okay, it's just how you do accounting. When you deal with assets that you sell, you have to draw a timeline. Okay, so 28. Yes. Okay, I'm actually going to draw it down here because I need more space. 28 of Feb 2018. Okay, how much was the asset sold for? That's the year end. We need to check. When did we sell it? It was originally bought second hand. Okay, so let's write that date in. Originally bought second hand for 20.
Yes, sir.
Oh, no. For 100.
No, sold for 20 years. Bought for 100.
Okay, so there's the 100,000. That's when I bought it. They said it was bought into use on the same day. Fine. Okay, lazy sold technology outdated manufacturing equipment for 20,000. That must have been during the financial year. So now, what am I? Am I a SBC? Well, I'm a CC. Do you see that?
Yes, sir.
I'm a CC. I need to look at the beginning of the question. The question says, there we go. See that?
Yes, sir.
Small business corporation. So do I use the capital allowances for an SBC? Yes, I do. Okay, so what type of asset do I have here? It's manufacturing. Do you agree?
Yes.
It's a machine. Do you agree?
Yes, sir.
Is it movable or immovable? Would a machine be movable or immovable?
A machine would be immovable, sir. Well, it actually depends, actually.
A machine could be movable, actually. It could be either or, actually, if you think about it.
Yes, sir.
Yeah, you could have a machine that's movable or a machine that's not movable. So, a little bit of a problem here, but it doesn't matter. We would assume that it's movable, because immovable would be looking at something like land and buildings, or buildings. So, we would assume movable here, right?
Yes, sir.
Okay, so let's go to our notes. Capital allowance for an SBC. Where is it? Capital allowances for an SBC. Okay, was this new or was this used?
It was used, sir.
Yes, it was second hand. Do you agree?
Yes, sir.
Okay, is this what we're going to look at? No. Why? Because they are SBC. Section 12E is easy because it's SBC. They have it easy.
Yes, sir.
Okay, and it can be new or used. Do you see that?
Yes, sir.
Okay, was the asset for manufacturing?
Yes, it was.
Yes, so how much do I deduct?
100%.
Good. See, that's the application of the rules. So I go back. Okay, so what does that mean? That means back in 30 of the 4th, 2014, back in that year, I would have deducted
100%.
100% of it in that year. I would have claimed a negative 100,000. Does that make sense?
Yes, sir.
Okay, that would have come off my taxable income. Okay, then all the other years, I would have had nothing. Why? Because I can't claim more because I already claimed 100% at the beginning. Does that make sense?
Yes, sir.
Okay, so now when we come to the recoupment, we need to work it out. So, how am I going to work it out? I need the selling price. Selling price was how much? 20,000.
20,000. Yes, sir.
Okay, then I need the tax value. What is the tax value? Well, do you agree the cost was 100 and the capital allowances was how much? 100. So what's the tax value?
100, sir.
0.
Oh, 0 because it was taken off.
See, that's the cost.
Yes, sir.
That's the capital allowance. Do you agree?
Allowance. Yes, sir.
100 minus 100 is?
0.
0. Okay, so now I've got a selling price of 20,000. 20,000 minus 0 gives you what?
20,000.
20,000 rand profit or recoupment. Do you agree?
Yes, sir.
Okay, what is the recoupment limited to? Previous allowances.
Yes, sir.
Okay, let me show it to you here. It's getting a bit untidy there. Here. Okay, so on this page, in terms of cost for the asset was 100k.
Yes, sir.
Taxable allowances previously claimed was 100k.
Yes,
100
sir.
minus 100 is 0 tax value.
Yes, sir.
Proceeds greater than tax value? Yes. 20,000 is greater than 0, so there's a recoupment of 20. Does that make sense?
Yes, sir. That makes
Okay,
sense.
the recoupment of 20 is limited to previous taxable allowances. So will
Yes.
SARS add 100 or will SARS add 20?
They'll add 20, sir.
Yes, 20,000. Okay, that's what they're going to do. Does that make sense?
Yes, sir. It's coming together.
Yeah, it's really simple. If you just think about it logically, then let's go to the answer. Where was it? 6.2. Here, okay, that's too far. 6.4, 6.2, there we go. See, and there's that whole discussion.
Yes, sir.
See, and you get a lot of marks for talking about theory. Okay, because some of this is even 0 and you still get a mark. Because remember, it's application of the theory, that's important. Okay, so that was very easy to do if you just thought about it logically. But again, just use the notes. The notes are everything. You don't really need anything else. You just need to apply it in different scenarios. So everything is separate. Keep it separate. Remember, the key is picking out what you've got and then just applying it.
Yes, sir.
Okay, does that sort of help you a bit more?
Yes, sir, it does.
Okay, great. Alright, so I'm going to ask you if you can go through some of these as well. If you have any questions, just let me know. I don't mind going through these. I can even do the whole thing with you if you want me to. Totally up to you. But yeah, they are quite long. They're actually test questions, to be honest. I've seen questions very similar to these in the actual exams. What I do like is this. Ooh, this looks good. Here's a nice summary as well. You could even use that as well for your studying. But again, it's in the notes. I've just represented it slightly differently when I was going through the material. Okay.
Yes, sir.
Any questions?
Great. No, sir. I'm just want to look what page that is on.
This is on page 81.
81.
81 of the second book. That looks like a nice summary.
Found it.
Complete the table. Yeah, remember, complete the table. It's obviously theory. So it was probably a test question or something similar, and they wanted you to fill in the blocks.
Okay.
Is that alright?
Yes, sir. Let me
Great.
just remember. Just look at this.
Yeah, so if you can, just try look at some of these.